Welcome back to our channel. Today, we're diving into the fascinating world of mergers and acquisitions, or M&A. We'll break down what they are, why companies merge, how it's recorded in accounting, and even look at a real Indian M&A examples. So stick around till the end. This video is packed with insights for your exams and interviews. Let's start with the basics. A merger is when two or more companies join forces to create a new entity. Think of it as two strong teams coming together to work as one. For instance, in 2019, Bank of Baroda merged with Dena Bank and Vijaya Bank, forming a single entity under the Bank of Baroda name. On the flip side, an acquisition is when one company buys another and takes control. A great example is Tata Sons acquiring Air India from the Government of India. Air India still exists, but now under Tata Group's ownership. Now, why do companies opt for mergers or acquisitions? There are several strategic reasons. First, economies of scale. Larger companies can produce more at a lower cost. Next, market expansion. It allows entry into new markets or regions. Then there's diversification, reducing business risk by adding new product lines. Synergy benefits come into play too, combining strengths to boost profits. And let's not forget tax or financial advantages. Sometimes mergers offer tax benefits or improve financial positions. Take the recent merger of HDFC Limited with HDFC Bank in 2023. It created India's largest private financial powerhouse, combining housing finance and banking. Mergers can be categorized into different types. A horizontal merger occurs between companies in the same industry, like the Vodafone and Idea merger. A vertical merger happens between companies at different stages of the supply chain, like a car manufacturer merging with a tire company. And a conglomerate merger is between companies in unrelated businesses, like a food company merging with a tech company. Now, let's talk about the accounting side, crucial for exams and corporate reporting. In India, mergers are governed by IND AS 103, business combinations. There are two main methods, the pooling of interest method for mergers and the purchase method for acquisitions. In the pooling of interest method, assets and liabilities are combined at book values, with no goodwill recognized. In the purchase method, assets and liabilities are recorded at fair value, and any difference in purchase price is recorded as goodwill or capital reserve. For example, if Company A acquires Company B for Rs 10 crore, and Company B's net assets are worth Rs 8 crore, the goodwill recorded would be Rs 2 crore. Now let's look at a real-world example, the HDFC Limited and HDFC Bank merger in July 2023. Before the merger, HDFC Limited was a housing finance company, while HDFC Bank was a private bank. After the merger, they became India's largest private financial institution. Shareholders of HDFC Limited received 42 shares of HDFC Bank for every 25 shares they held in HDFC Limited. In terms of accounting, this merger was treated under the purchase method, as per IND AS 103. All assets and liabilities of HDFC Limited were transferred to HDFC Bank at fair value, with the difference becoming goodwill in the consolidated balance sheet. The impact? A market capitalization of over Rs 14 lakh crore post-merger, with HDFC Bank gaining direct access to home loan customers and HDFC Limited tapping into a vast banking network. So, what are the key takeaways? A merger means combining, while an acquisition means taking over. The accounting treatment varies, pooling for mergers and purchase for acquisitions. Real-world examples include Vodafone plus Idea, HDFC Limited plus HDFC Bank, and Tata plus Air India. And always refer to IND AS 103 for exam-oriented questions. That wraps up our discussion on mergers and acquisitions, the concepts, accounting, and a real-world example. If you found this video helpful, give us a thumbs up share it with your friends, and don't forget to subscribe for more finance and accounting insights. Learn finance the smart way. Subscribe now.